been sitting on my hand. I will say that I have devil's advocate in terms of perhaps the way the federal government looks at it. And I want to bring into focus Judy Shelton's argument of issuing 50-year treasuries. Mm-hmm. Because as we said earlier, we have that $37 trillion debt, but the unfunded liabilities, Jason's point, in Medicare, Medicaid, Social Security exceed $175 trillion. By the government's own admission, we're pretty darn well near $200 trillion in debt. There's no way to pay that off. You bring in Doge, well, at least right now there's not, unless we were to bring all the manufacturing home and grow our way out of it, which would lead to the Great Depression long before we were able to grow. But just for a moment, if I would, and that would be that if we take a look at this massive indebtedness, obviously, and you bring in Doge who points to $2 trillion in reckless spending that we could save, but yet Congress doesn't have the political will to do anything more than $80 billion, and that $80 billion that they agree upon is 38 hours of spending by the government, amounts to nothing. So to Judy's point, in a world where the Treasury bond is losing demand globally, and that's not something that's even debatable. How do you find demand in a country where Trump wants to raise the debt ceiling? There's going to be another $3 trillion deficit. We owe $28 trillion in treasuries that are coming due in 3 years, yet we only take in $5 trillion in tax revenue. He wants to lower taxes, but not lower spending. That's a problem. And even if you don't lower taxes and you keep it at $5 trillion, that's $15 trillion. We owe 28, but that doesn't take into account the $3 trillion this year and whatever we do the next 2 years in deficit spending. The math doesn't add up. So how do you find demand for the Treasury bond in that environment without letting rates go parabolic to attract that demand? If rates do go that high to attract demand, what happens to stocks? What happens to bonds? What happens to real estate? What happens to the banks? At 5%, they started to break. What happens at 10? What happens to the insurance companies who are loaded with treasuries? It's called bang, the Great Reset, everything implodes. So enter Judy Shelton. You reshore all the gold. Oh, wait, didn't we just say we become net importers of gold? I think we did. Over $100 billion that we know of. You contemplate revaluing gold. Where is gold held? Oh, yeah, in the gold revaluation account. That's the name of it. You can't make it up. It's happened 3 times before in this country. Who would that benefit? Well, that would benefit every central bank on the planet, number one. It would also benefit the United States government if indeed it is the entity behind this massive month over month imports of gold at record levels. The largest import ever into the history of the COMEX on the May contract. Who's standing for delivery for almost $9 billion in gold? You put all this stuff together. Okay, Judy, so we peg a 50-year treasury to gold. Why? Well, because what that does, if you do revalue it, now James Rickards says 24,000. He comes up with that number by taking the money supply and dividing it into the gold that hasn't been audited since 53, and he gets this 24,000, which would give the Treasury general account $6 trillion free and clear. Treasury would issue gold certificates to the Fed, who would print the money out of thin air and give it to the Treasury. Those gold certificates give the Fed claim on the dollar value of the gold, not the gold that belongs to the people. So that printing of the money completely devalues the dollar, just like Nixon did in 72 and 3, and just like Roosevelt did in 33. Devalues the dollar, which is what they want to do, creates copious inflation, which is the lesser of two evils rather than default or hyperinflation, but it would create a lot. That makes it easier to pay off the debt, but that still doesn't deal with how do we get low borrowing costs? Well, we peg the Treasury to gold and redeemable upon maturity. Therefore, you can offer zero coupon treasuries because that inflation hedge is the gold. It's not the 8 or 9 or 10% yield that would kill the markets. Boom, everything blows up. Instead, you peg gold to it. You got a 50-year runway. And then in that environment, because of the low borrowing costs, you inflate your money to pay down the debt. The Treasury gets $6 trillion under Jim's scenario to start paying down the debt. And then you start reshoring your manufacturing at a very, very low cost of borrowing. And you try and produce your way out of it. In my opinion, what the hell do I know? I think it's the only way that you can get out of this quandary we are in without either massive hyperinflation, which leads to interest rates going to the moon, which blows it all up, or quantitative tightening, which has interest rates go to the moon, which blows it all up. I think Judy's onto something. I think that would be the first step, would be to reshore all the gold. We see that.
I want to take you through something that is, frankly, both terrifying and fascinating. A scenario that, while still whispered about in the margins, may soon become front and center in our economic discourse. And it starts with a number that should shake everyone awake: $37 trillion. That's the U.S. national debt. But if you factor in unfunded liabilities like Social Security, Medicare, and Medicaid, we're looking at north of $175 trillion. That's according to the government's own numbers, not fringe blogs or financial doomers. If we're being honest, we are likely closer to $200 trillion in total obligations. It's not just unsustainable, it's mathematically impossible. So the question is, how do we survive it? The political will to cut spending is non-existent. You get press releases about shaving off $80 billion in cuts, which the media frames as some Herculean effort. But $80 billion amounts to about 38 hours of federal spending. Imagine trying to patch a ruptured oil tanker with a Band-Aid. That's our fiscal policy. Now, I want to play devil's advocate. Let's talk about Judy Shelton's idea, the notion of issuing 50-year treasuries backed by gold. To many, this sounds like a fringe proposal. To me, it sounds like a chess move 5 steps ahead of the game. Judy's idea isn't about going back to a Bretton Woods-style currency peg. It's about something more strategic, using gold not to back the currency, but to back long-dated U.S. treasuries. Think about that for a second. A 50-year treasury backed by gold and redeemable in gold at maturity. That's not just a novel idea. It's potentially the only way we attract demand for treasuries without sending interest rates into the stratosphere and crashing the entire system. Let's break down how this might work. James Rickards, who's done some brilliant work on this, has a model where the U.S. revalues gold to $24,000 an ounce. Sounds outrageous? Well, that number isn't pulled out of thin air. It's derived from taking M1, the narrowest definition of the money supply, and dividing it by the 261 million ounces of gold supposedly held by the U.S. Treasury, assuming those bars are still in Fort Knox. Spoiler, we haven't audited them since 1953, but for the sake of argument, we go with that number. Now, if gold is revalued to $24,000 per ounce, the Treasury can issue gold certificates to the Federal Reserve, just like Roosevelt did in 1933, just like Nixon did in 1971. Print money based on the new gold price. That gives the Treasury General account a massive $6 trillion injection without technically increasing the debt. Think of it as an asset-backed bailout. Who benefits from this? Everyone holding gold, obviously. Central banks? Big time. They've been hoarding gold for a reason, and now it starts to make sense. It would also benefit the U.S. government, particularly if it's been one of the entities behind the record-breaking gold imports we've seen this year. We've had month after month of unprecedented delivery volumes on the COMEX. In May alone, over $9 billion worth of gold was stood for delivery. Who is standing for that? That's not a hedge fund play. That's sovereign. The idea of a gold-backed treasury gives foreign buyers who've been dumping treasuries like they're radioactive a reason to come back to the table. You're not offering them 8% yields that crash your banks and destroy your mortgage market. You're offering them zero-coupon treasuries redeemable in something tangible: gold. This is genius-level monetary chess, and it solves 3 problems at once: funding future deficits, avoiding a catastrophic spike in interest rates, and creating a built-in inflation hedge that doesn't destroy equity markets overnight. Let's be clear about something. This isn't just about saving the dollar. It's about saving the treasury market, which is the bedrock of the entire global financial system. The whole world is built on the assumption that U.S. debt is risk-free. If that illusion cracks, we're not talking recession. We're talking systemic collapse. Look around. China is dumping treasuries. Japan is cutting back. BRICS nations are de-dollarizing aggressively. The Shanghai Cooperation Organization, the Belt and Road Initiative, and now the M-Bridge platform, they're all working in tandem to create a settlement infrastructure that doesn't require the US dollar at all. Gold is the neutral settlement layer, not Bitcoin, not SDRs. Gold. Let's pull this into focus. In May, the Chinese were importing over 500 tons of gold in a single month. BRICS plus nations are developing multi-jurisdictional vault systems so that gold can be deposited regionally and used to settle trade imbalances. You don't need a single Fort Knox. You've got 20 Fort Knoxes in friendly countries, each holding a piece of the new global reserve infrastructure.
And I think you can just look at this year as a prime example. The dollar's down 10% and gold's up 38%. So you're talking almost a 50% swing. And if the state were to have been holding its reserves in gold, it would be far, far, far better off from a standpoint of purchasing power than it would be just holding it in dollars. All fiat currencies are inherently meant to die, and the policies of this current administration center around a weakening dollar and lowered interest rates, which is inflationary. This is why the smartest money in the world has been accumulating gold hand over fist, that being the central banks. And I would add into it somewhere in the neighborhood of 100 billion with the B dollars that we know of, and I would argue there's probably a lot more that isn't reported, has been delivered into the COMEX market since November. And you're talking the most well-informed, the most well-funded, and the most sophisticated traders on the planet. Now, who is doing this? Who's got those pockets? And so, yeah, I think that there is no question at the highest level, and the only ones who would vote against that would be the banks, because it takes away, obviously, much of their power and leverage, as they've already seen a mass exodus of deposits leave the banking system chasing yield to treasuries. I'm sure the last thing they want is to see legal tender in gold, which would be a far, far, far more sound way of holding your wealth. And, you know, people get too focused on return or yield. There is no yield on gold, obviously, and they focus too much on that. But if you look at its performance over the last 25 years, it's doubled the performance of the 10-year treasury. So it doesn't need yield attached to it, because inherently what it does is it maintains your purchasing power. It sniffs out the stealth monetization or the stealth inflation that is inherent to the system and continues to move higher. Whether you look at last year, gold was up 40%, the 10-year treasury up 4.5%, or this year, the 10-year treasury up 2.5% halfway through the year, but the dollar down 10, you're negative 7% in the hole, plus, yet gold's up 38%. So when you talk about allowing the constituents the ability to get out of the way of irresponsible fiscal policy and arguably brain-dead monetary policy, it would be the best thing in the world for the constituents. Jason, am I wrong in saying that it was a unanimous bipartisan vote in Utah, but for whatever reason, the governor vetoed for the first time a unanimous bipartisan agreement? Am I wrong in saying that?
So it was unanimous, I think, in the House, and I think nearly unanimous in the Senate. And it's certainly certainly of his own party, the Republicans, was unanimous. And I don't think that's ever happened
His reasoning in that case, when you have the entire will of the people and the majority of the legislature saying, yeah, let's do this. The state feels it's smart enough to add 100 million into its coffers. Yeah, I mean, what you are doing, Jason, not only in building a wonderful business, but also in really representing sound money, and in many respects, the United States, the will of the people with the legislature is fantastic. And it's a growing trend that I think will continue to manifest. You're seeing it here in Florida. I spent time with some of the people in the economic war room yesterday on the phone going over all of this. And I think really this is a grassroots movement that is gaining momentum, certainly around the country. So it's exciting to see. And
You know, if you zoom out far enough, this whole thing starts to look like a bad rerun. We've seen this before. Nixon in 71 decoupling the dollar from gold, Roosevelt in 33 confiscating gold and revaluing it overnight. Twice in 1 century, we've weaponized the gold price to save the financial system. And here we are again, just a few steps away from another monetary sleight of hand, this time dressed in digital robes and wrapped in sound finance branding. Let me get back to Judy Shelton's proposal, 50-year treasuries tied to gold. I mean, on the surface, it sounds almost fantastical, right? But let's be honest, does anything else actually pencil out anymore? We've got close to $200 trillion in unfunded liabilities. The math is screaming at us like a toddler on sugar. You can't pay that down with $5 trillion a year in revenue. And you definitely can't keep refinancing it with short-term paper unless you're trying to set the banking system on fire, which, judging by the state of commercial real estate, regional bank balance sheets, In Fed policy, we're already halfway there. So instead, we enter this bizarro world where suddenly the most old-school asset on the planet, gold, is getting pulled back into the spotlight not as a currency anchor, but as a yield support mechanism. You peg a 50-year treasury to gold, and suddenly you don't need to pay a 9% coupon to get people to buy it. The inflation hedge is built in. It's elegant. Even Rickards, who gets flack for being dramatic, has laid out this blueprint. A $24,000 gold price to match the M2 money supply. That's not some random moonshot, that's math. And here's the twist. You don't even have to make it convertible to the public. In fact, you probably shouldn't. If you make a gold-backed treasury available only to sovereigns and large institutions, central banks, pension funds, you preserve the confidence game in the fiat system while locking in demand for treasuries. That's the genius of it. You let the dollar float and inflate and wither, but behind the scenes, you give the institutions an escape hatch. Gold backing, quiet, formal, opaque, just like they like it. There's historical precedent here too. The Treasury Gold Certificate account was created under the Gold Reserve Act of 1934. When Roosevelt confiscated private gold and revalued it from $20.67 to $35 an ounce, the government booked a tidy profit. That profit was used to inject capital into the Reconstruction Finance Corporation and the banking system. It was basically a massive stealth bailout. Today, that same playbook could be used again. Revalue gold, book the difference, and plug the fiscal gap. And let's not forget, the US doesn't have to own all the gold. It just needs to declare a higher price. If gold is sitting in private vaults, in ETF custodianships, in COMEX warehouses, fine. The government can revalue gold unilaterally, and everyone holding it gets richer in dollar terms. The real magic is in how it lets the Treasury monetize gold without actually selling any of it. That's the alchemy here. It's like printing a $1 trillion coin, except the coin is gold and it's already been mined. You think this is a fringe theory? Ask yourself why the US has been importing record amounts of gold, over $100 billion worth, just in the last couple years. Why are central banks around the world, especially in the East, stacking gold like it's going out of style? Why is the Shanghai Gold Exchange pushing for internationalization through multi-jurisdictional depositories? Why did BRICS launch a settlement system backed by gold distribution across vaults in Saudi Arabia, Africa, and Asia? You can connect the dots if you're willing to dig. Hell, even the BIS has quietly acknowledged gold's re-emerging role as a Tier 1 reserve asset under Basel III. That was the signal. Everything since has been noise. While the West sleeps and argues about CPI print manipulation, the East is building an entirely new monetary infrastructure. And we are now months, not decades, away from the point of no return. Look at the EM Bridge platform. It's live. It's functioning. 11 Southeast Asian nations and 5 in the Middle East are already using it. That represents close to 40% of global GDP. Add in the Belt and Road Initiative, the Shanghai Cooperation Organization, the Eurasian Economic Union. You're suddenly covering 70% of the world's population. And what are they trading with? Yuan, local currencies, and gold. Not dollars. This is what people don't understand. The dollar isn't being replaced by another currency. It's being bypassed. That's worse, because a competitor can be fought. Bypass means irrelevance. Ask MySpace how that feels. Ask Blockbuster. And now you've got Sergey Lavrov out there saying that the new payment system is open to non-BRICS members, except the euro, the pound, and the dollar. That's the shot across the bow. That's the equivalent of the BRICS putting a velvet rope across the club entrance and saying, sorry, fellas, you're not on the list. And that's not just political posturing. That's a fundamental reshaping of global capital flows. The U.S. Treasury market is the foundation of the global financial system. If foreign buyers walk away, not suddenly but gradually, who fills the gap? Domestic institutions? Maybe. But they're already loaded up with duration risk. The Fed? Possibly, but then we're talking about yield curve control on steroids. The only way out without detonating the bond market is to make treasuries attractive again without offering insane yields. And the only way to do that is to tie them to something real, something scarce, something shiny. People will say, but Andy, we've got Bitcoin now. Isn't that the new gold? Look, I'm a fan of crypto as an idea. The decentralization, the transparency, the immutable ledger, I get it. But at the end of the day, in a crisis, Bitcoin is still a risk asset. Gold is an insurance policy. Always has been, always will be. If central banks start backing sovereign debt with gold, do you really think they're going to do that with Bitcoin? Not yet, maybe someday. But today it's gold. And Judy Shelton understands that. Even the World Gold Council has started winking at this idea. In their 2024 report, they talked openly about sovereign gold-backed instruments and the increasing calls from emerging markets to rebalance global finance around neutral, apolitical stores of value. That's gold speak for we're done trusting the dollar. And let's talk about that trust, because that's the real issue here. Money is trust. Fiat currency is just a belief system. It works only so long as everyone agrees it has value. But trust is waning. When Congress debates whether to fund the government for another 45 days and the Fed is actively debating how many trillions to not sell off its balance sheet, you know trust is thinning out like a comb-over in the wind. This is what the BRICS understand. This is what Lavrov understands. This is what Xi understands. You don't attack the dollar head-on. You surround it. You build alternatives. You create redundancy. You make gold a settlement tool. You make Bridge a payment tool. Meanwhile, we're here in the West, wondering why nobody showed up at the last treasury auction. You've got the makings of a monetary endgame. And this isn't conspiracy theory. This is strategy. This is game theory. This is exactly what you'd do if you were a rising economic bloc with resource-rich allies, a manufacturing base, and declining faith in Washington's ability to govern. The path is being laid, brick by brick. The rails are already built. And when this transition fully manifests, and it will, the repricing of gold won't be some gentle climb. It will be a violent reset. You don't have to believe me. Just follow the flows, follow the vaults, follow the trade agreements, follow the silence. The silence is the key, because the media's not covering this. The mainstream is still worried about whether CPI is 3.2% or 3.3%. That's like debating whether the Titanic hit one iceberg or two. Irrelevant when the ship is going down. And here's the real kicker. Even if this gold-backed treasury idea doesn't get implemented tomorrow, the sheer fact that we're talking about it seriously now, that Judy Shelton floated it, that Rickards laid out the math, that people in Washington aren't laughing it out of the room, that tells you something. The Overton window has moved. Gold is being normalized again. Not as jewelry, not as a relic, but as a monetary asset, a bridge between trust and solvency. So what do you do as an individual? You front-run it. That's it. You front-run the revaluation. You get out of the paper promise system and into the asset that all these governments are moving toward anyway. Gold. Silver too, if you like a little more torque. But don't wait for the press release. The big boys have already positioned. You don't want to be the one chasing the train after it leaves the station. And if I'm wrong, if none of this ever happens, what's your downside? You hold an asset that's been money for 5,000 years. That seems like a pretty good worst-case scenario to me. I'll leave you with this. In 1933, they revalued gold from $20.67 to $35. That's a 69% devaluation of the dollar overnight. In 1971, gold was unpegged, and by 1980, it hit $850. That's a 4,000% increase. If it happens again, and the math points to $10,000 or $24,000 or even higher, will you be ready? Or will you be the one saying, I never thought they'd actually do it? Because trust me, they will. History doesn't repeat, but it sure does rhyme. And this next stanza is written in gold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.